Good morning, class. My name is Himang Dalal, and we are Group 1 for this presentation assignment. In this presentation, we are going to discuss a couple of accounting concepts with regards to financial statement and taxation effects on company revenue. When a company makes money in Australia, they know they have to give some of it to the government as income tax. But here's a twist. The amount of money they actually pay in taxes each year are often doesn't match with what they report as an income tax expense in their financial statements. Now, why is this different? Well, it's because the way company do their accounting and how the taxes work. You see, when companies calculate their profits, they follow accounting standards. But when they calculate how much tax they owe to the government, they follow taxation regulations. So this is the reason why there is a difference between those two. In this discussion, we are going to explore why these differences happen and what they mean for companies and the government. We'll break down the distinction between accounting profit and taxation profit, and why a company might not owe any tax to the government even if it's making profit, and how incurring losses can impact taxes. Now, I'm covering question number 1, the differences between accounting profit and taxable profit. Understanding these differences in both understanding the differences is important for both companies and government to make sure everything adds up correctly and that everyone pays their fair share. So let's dive into the mystery behind why the numbers don't always match up. Now, in the area of corporate accounting and taxation, the concepts of accounting profit and taxable profit play very important roles in assessing companies' financial position. To tell you in a definition, accounting profit is the profit that is reported by a company in its financial statements, such as income statement and statements of profit and loss. And it is calculating simply by subtracting expenses from revenue and adhering to accounting principles and conventions given by accounting standards. Whereas taxation profits are the profits that are derived by following taxation laws, and it's on the other hand is the profit which is company is required to pay taxes to the government. It is calculated based on the tax laws and regulations and jurisdictions. Now, as I said that there are differences between taxable profit and accounting profit. Now, there are three main reasons why there are differences in accounting profits and taxable profits. One of them is timing difference. Certain revenues or expenses may be recognized differently for accounting and tax purpose. For example, depreciation and inventory valuation method. The second reason is non-deductible expense. Some expenses that are deductible for accounting purpose may not be deductible for tax purpose. The third important reason is tax credit and incentives. The tax laws often provide for tax credit incentives or deductions that are not considered in calculating accounting profit, but they are only considered in calculating tax profit, and they directly impact tax profit. All right. The next question will be given by my colleague, Mr. Yang. Thank you.
Hello everyone, I will discuss the question about income tax expense and income tax payable, which will they be the same at the end of that accounting period? First of all, let's talk about the similarities that they shared. Both of them pivot around income taxes, serving as vital indicators of companies' tax position. They adhere to stringent accounting standards, such as Australian Accounting Standards Board 12 and International Accounting Standards 12, ensuring transparency and accuracy in tax reporting practice. However, they are different. Income tax payable signifies the concrete obligation a company holds toward tax authorities for the current reporting period. It reflects the actual amount owed to the government, meticulously calculated based on taxable income, tax rates, and allowable credits or deductions. In contrast, income tax expense provides a broader perspective. In comparison, both the current tax liability and potential future tax consequences. It includes deferred tax considerations arising from temporary disputing financial and tax reporting. Income tax expense showcase the company's foresight in provision for its complex tax burden and display in the statement of profits or loss and comprehensive income. In conclusion, while the income tax expense may be an estimate of the tax liability for the period. The income tax payable will be the actual amount owed to the government, which can be different due to timing difference, tax credits, deductions, and other factors. Thank you.
Hi, my name is Yazali, and my student number is 2023034061. Now I'm going to talk about question 3. Why might a profitable company not have any income tax payable to the relevant taxation authorities? This seems paradoxical, as we generally expect profitable companies to pay their fair share of taxes. However, there are several reasons that can lead to this situation. Firstly, a company may have accumulated tax losses from previous years that can be carried forward to offset current year's payable taxable profits. This reduces or potentially eliminates the company taxes liability for the current period. Secondly, there are timing differences between accounting rules and tax laws in the recognizing incomes and expenses. Some revenues are taxed in a different period than when accounted for, while some expenses are tax deductible in a period different from when they impact their accounts. These temporary mismatches can result in a company having an accounting profit but reduce or no taxable income. Thirdly, the company may be eligible for various tax credits and incentives designed to promote activities like research, development, or investment. These tax breaks directly reduce the actual tax payable accounts. Fourthly, certain income sources are exempt from taxation, such as dividend income from subsidiary companies or income from specific investment types or geographic zones. Moreover, companies employ legal tax planning strategies like transfer pricing policies, utilizing low tax jurisdictions, or structuring transactions efficiently to minimize their overall tax liability within a purview of the law. Finally, differences between tax depreciation rules and accounting depreciation policies can lead to variance in taxable profits versus accounting profits. It is crucial to note that despite having no income tax payable, companies still need to recognize tax expenses or benefits as per accounting standards, creating deferred tax positions on their balance sheets.
The question 4 is, would incurring a loss for tax purposes result in the recognition of a tax-related asset in the financial statements? Why? The answer is yes. As it's a future deduction against future year's tax payable profits, meaning it will result in reduction in future tax payable or potentially a refund of tax paid in the future year. This can be explained in 3 parts. The first is deferred tax asset. When a company incurs a loss for tax purposes, it creates a future tax benefit known as a deferred tax asset. It means that its tax payable income, as calculated for tax assessment purposes, is lower than its accounting income, leading to a reduction in the amount of income tax payable to the government. This variance arises due to the difference in timing and recognition criteria between tax law and accounting standards. Deferred tax asset represents the amount of taxes a company can save in future periods because it can offset tax payable income with the current period's tax losses. Essentially, this allows the company to reduce its future tax liabilities, resulting in potential tax savings, which reflect the potential tax benefits in its financial statements, improve its overall financial position. Even though the company may have incurred a loss for tax purposes in the current period, recognize a deferred tax asset allows the company to reflect the potential tax benefits in its financial statements, improve its overall financial position. The second reason is potential tax refunds. In addition to reduce future tax payable, recognize a deferred tax asset on tax losses may also open up the possibility of receiving tax refunds in the future. If the company is unable to utilize its tax losses fully in future periods, it may be eligible for a refund of taxes paid in previous years, providing a valuable source of liquidity. The last reason is impact on financial statements. The recognition of a deferred tax asset due to tax losses incurred has a direct impact on the company's financial statements. It increases the reported assets on the balance sheet, reflecting the future tax benefits that the company expects to realize. Moreover, it can also impact the reported income tax expense in the statement of profit and loss, as the company may need to adjust its provision for income taxes to reflect the expected tax savings. In conclusion, incurring a loss for tax purposes does lead to a recognition of a tax-related asset, specifically a deferred tax asset, in the financial statements. This recognition reflects the company's ability to carry forward tax losses and use them to reduce future tax liabilities or potentially receive tax refunds, thereby improve its financial position and profitability over time. Let's invite Xiangli to analyze the next question. Thank you.
Thanks, Wenjing. Now let me talk about question 5. What steps should be taken when there is a change in tax rate and why? Firstly, we need to know the impact on the change of tax rate. Firstly, it will related to the accounting standards. Normally, changing tax rate will affect AASB. It related to the income tax, and it requires the recognition of deferred tax and assets and liability based on the related tax rate. Secondly, it will affect the financial reporting. This involves conducting a detailed analysis to determine how the changes will affect taxable income, tax expense, deferred tax assets, and liabilities, and ultimately the bottom line. So in current situation, what should we do? The Australian government announced a reduction in the corporate tax from 26% to 25% for the upcoming fiscal year. And what steps should be taken for the corporation in the current situation? Here is the breakdown of the necessary steps. First, we need to understand the changes, why the policy happens. This is all because the government wants to economic stimulus package aimed at attracting more investment and fostering the business growth. Secondly, after we understanding the impact, we need to assess the impact. Let's assume if a company have like $1 million of taxable income, when there's 1% decrease in the corporate tax rate, which means there's like $10,000 decrease in the taxable liabilities. And next, we need to update the tax plan strategies. The company may review its tax plan strategies in light of the lower tax rate. It might considering as accelerating certain deductible expense or restructuring its operations to optimize tax efficiency on the new regime. Next, we need to adjusting the financial statement. The company revised its financial statements to reflect the impact of lower tax rate. It adjusts its income tax expense calculation accordingly, resulting in a lower provision for income tax in the financial statement. It is crucial because it ensures compliance with relevant standards like what I talk about, the AASB 112, which requires the recognition of different tax liabilities. And it also enhances the transparency and helps stakeholders to understand the impact of the change. Next, we need to communicate with stakeholders. The companies communicate the impact of the new tax rate to its stakeholders through the annual report and investor presentations. It emphasized the potential saving in tax liabilities and how it plans to reinvest or redistribute these savings for the benefit of shareholders. At the same time, the company can implement internal controls and monitoring the development. The company can update its internal controls and procedures to ensure compliance with the new tax rate. It provides training to its finance and accounting teams to ensure they understanding the changes accurately and apply them in the financial report. Also, the company can continue to monitor developments in tax legislation and regulations. It's informed about any further changes or guidance issued by the ATO to ensure ongoing compliance with the tax laws. So all in all, companies can effectively manage the impact of changes in tax rate on their financial statements while ensuring compliance with relevant accounting standards, reporting regulations, current affairs. This approach helps maintain transparency, accuracy, and trust in financial reporting practice, ultimately contributing to the company's credibility and success in the business landscape. And that's all for today. And here is our reference. Thank you, everyone.